about private equity real estate returns. So basically, how do people make money inside a private equity real estate investment or fund? So there's several investors involved, right? And it's based on the capital stack that we talked about earlier. So the capital stack, starting at the bottom, is the senior debt lenders. And these are banks that lend you money, or they could be private lenders, but they are people that are putting in the probably the most capital in the investment, and it's in the form of a debt. And they make money based on the interest they charge for providing that loan. And the other people that make money in the loan would be any origination fees, so any mortgage broker or somebody that facilitated or originated the loan. Mezzanine debt lenders make money the same way as the senior debt lenders in that they would make interest on their loan that they provided. Also, there might be some origination fees paid to, again, another mortgage broker or loan coordinator. Plus, if the mezzanine debt holders convert their debt into equity, they have the potential to make money from the profits of the investment over a period of time when the final sale of the investment is made, when the final sale of the real estate is made. Next in line of the capital stack is the private equity investors, and these are the limited partners. These are the people that are supposed to be making the most money, or at least where most of the profits are being distributed. So they get what's called a base return or preferred return, which usually is in the 7 to 8% range, and that's a return that's promised to them by the company, by the private equity real estate company. So what happens is they get their base return, and then above and beyond that, they will usually get a return, an additional return from additional profits from the investment. So let's say they have a return, a preferred return of 7%, and the overall profits from the investment comes out to, let's say, 20%. Okay, so that's a difference of 13%. Okay, so that 13% is shared between the general partners and the limited partners. The general partners usually get about 20% of that 13%, and then the balance, the 80%, goes to the investors, the limited shareholders, or the limited partner. Okay, so the shareholders or the limited partners, which are the overall investors, the silent investors, get their base 8% plus they get 20% of any addition, or sorry, they get 80% of any additional profits above and beyond their base amount. And then finally, the common equity, which is equity that's owned usually by the general partners, and for their portion of their investment, they would get their return on their portion of the profits. Private equity firms also get paid fees, and these fees are usually acquisition fees and disposition fees and management fees. Acquisition fees are fees that they get paid when they go out and acquire a property. So if they purchase a property, let's say for $100 million, and they get a 2% acquisition fee, they would make $2 million on that acquisition. As well as when they went to sell the property, if they sold it for, let's say, $200 million, they would get another, let's say, 1%. So they would make another $2 million on the sale of the property. And finally, they usually get a management fee of in the neighborhood of anywhere from 1% to 4%. So let's say if they got a 1% fee, they would make another $100 million or another $1 million a year just on the management of that property. Okay. And then finally, they would also get a portion of the overall profits, the general partners, called carried interest. And this is above and beyond what the additional profits were made beyond what they contributed to the investment. So in that scenario I talked about earlier, where there was an additional 13%, they would make 20% of that 13% of the total profit. And then finally, there's dividend recapitalization, which is a special dividend that is paid to all of the shareholders by issuing new debt. And that's a more complicated scenario, but it's used to provide liquidity to shareholders and without impacting any of the ownership. Okay, so that's what I want to talk about private equity real estate returns.